Have you ever wondered how a single bank's failure could lead to a global financial meltdown? How did the collapse of one of Wall Street's most iconic institutions unravel the stability of financial markets, sending shockwaves through economies around the world? Lehman Brothers, a firm with over 150 years of history, seemed invincible until it wasn't. But what exactly went wrong? And why did its downfall mark the tipping point for the 2008 financial crisis? The rise of Lehman Brothers. Lehman Brothers started as a humble cotton trading business in 1850, founded by German immigrant Henry Lehman and his brothers. Over the next century, it transformed from a small commodity trading firm into a banking giant, heavily involved in investment banking, private equity, and the issuance of bonds. By the 21st century, Lehman Brothers had established itself as one of the most respected names on Wall Street, consistently turning profits and expanding into various sectors of finance. But beneath the surface of success, trouble was brewing. Lehman Brothers played a significant role in the housing market, engaging in risky mortgage-backed securities. As the housing bubble inflated, Lehman took on more and more exposure to these high-risk loans. The firm's aggressive expansion into subprime mortgages was a ticking time bomb. At the peak of its power, few could imagine that Lehman Brothers would soon find itself at the center of a financial storm. In the early 2000s, the U.S. housing market was booming. Low interest rates and easy credit encouraged people to buy homes, often beyond their means. Banks, including Lehman Brothers, were quick to jump in, packaging these mortgages into complex financial products known as mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. These were then sold to investors around the globe. Lehman Brothers was heavily involved in underwriting these securities, with billions of dollars tied to the housing market. While the firm profited from this arrangement in the short term, the long-term consequences were dire. As more and more subprime borrowers defaulted on their loans, the value of MBS and CDOs plummeted, exposing Lehman's massive overexposure to toxic assets. As the housing bubble burst in 2007, subprime mortgage defaults soared. The value of mortgage-backed securities, which had been considered safe investments, began to unravel. For Lehman Brothers, this was catastrophic. The firm had borrowed huge sums to fund its investments in these risky assets, and when the value of these assets declined, Lehman faced enormous losses. Lehman tried to offload some of its bad assets, but it was too late. By the time the market fully recognized the scale of the subprime mortgage problem, investors had lost confidence in the firm. Lehman's stock price plummeted, and its access to credit dried up. Despite attempts to secure a buyer or a government bailout, the firm was running out of options. Lehman's fate was sealed during a fateful weekend in September 2008. With losses mounting, Lehman's CEO, Richard Fuld, scrambled to find a lifeline. The US government, having already bailed out Bear Stearns earlier in the year, was reluctant to intervene again. Negotiations with potential buyers, including Barclays and Bank of America, fell apart due to regulatory and financial concerns. The firm was left with no viable options to stay afloat. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history, with the firm holding over $600 billion in assets. The collapse of Lehman Brothers sent shockwaves through the financial world, and the ripple effects were felt globally. Markets plunged, and financial institutions scrambled to assess their exposure to Lehman's toxic assets. Lehman's collapse was the spark that ignited a full-blown financial crisis. The global banking system, already fragile due to the subprime mortgage problem, teetered on the edge of collapse. Banks were suddenly unwilling to lend to one another, fearing that they too could be holding toxic assets. This credit freeze spread across the economy, leading to a severe contraction in global economic activity. Governments around the world were forced to intervene. The US government, which had declined to bail out Lehman, was soon rescuing other financial giants, including AIG and Citigroup, to prevent the entire system from unraveling. Central banks slashed interest rates and injected liquidity into the financial system, but the damage had been done. The collapse of Lehman Brothers triggered a chain reaction that led to the worst global recession since the Great Depression. The collapse of Lehman Brothers raised important questions about the structure of the global financial system. One of the central debates in the aftermath was the issue of moral hazard. The idea that if the government bails out failing institutions, it encourages risky behavior in the future. Lehman was allowed to fail, in part because policymakers believed that it would send a message to the market. Not every firm would be saved. However, the decision to let Lehman fail also exposed the dangers of the too big to fail doctrine. Lehman's interconnectedness with other financial institutions meant that its collapse caused a cascade of failures across the banking system. The lesson was clear. Some firms had become so large and so entangled in the global economy that their failure could not be contained. In the wake of the crisis, governments and regulators implemented a series of reforms to prevent a repeat of the events of 2008. The Dodd-Frank Act, the United States introduced stricter regulations on banks, including higher capital requirements, stress tests, and rules designed to limit risky behavior. Global regulators also tightened rules on capital reserves and increased oversight of the shadow banking sector. Yet, more than a decade later, questions remain. Have we truly learned the lessons of Lehman Brothers? Or are we still vulnerable to a similar collapse? Some argue that while regulations have improved, many of the systemic risks that led to the 2008 crisis, such as high levels of debt and the complexity of financial instruments, still exist. Others believe that the financial system has become more resilient, with better safeguards in place to manage future crises. The collapse of Lehman Brothers and the subsequent financial crisis had devastating human consequences. Millions of people lost their jobs, homes, and savings as the global economy spiraled into recession. In the United States alone, unemployment soared to over 10%, and foreclosures reached record levels. The crisis wiped out trillions of dollars in household wealth, and the economic recovery was slow and painful. In the aftermath of the 2008 financial crisis, governments and regulators took steps to address the vulnerabilities that had been exposed. In the US, the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010, bringing in sweeping financial reforms aimed at preventing another crisis. Among the key changes were higher capital requirements for banks, stress tests to ensure financial institutions could withstand economic shocks, and new regulations on derivatives, complex financial instruments that had played a major role in the crisis. Globally, financial institutions were also subjected to stricter regulations, with higher capital reserves being required to ensure they had a buffer in times of financial distress. Central banks around the world, including the Federal Reserve and the European Central Bank, introduced measures to stabilize the financial system, such as providing emergency liquidity to banks during periods of financial stress. However, despite these reforms, many experts believe the risk of another financial crisis remains. While the specific causes of the 2008 crisis, subprime mortgages, and highly leveraged banks may have been addressed, other risks have emerged. The financial system remains deeply interconnected, and many of the institutions that were bailed out during the last crisis are even larger today. Moreover, some of the financial innovations that contributed to the 2008 crisis, such as complex derivatives and high-risk lending, continue to exist in various forms. While they may not be as prevalent as they were in the lead-up to the crisis, they still pose a risk. Additionally, the global debt level has reached unprecedented heights, raising concerns about what would happen if the world were to experience another economic downturn. One of the most significant dangers lies in the rise of shadow banking, financial institutions that operate outside the traditional banking system and are not subject to the same regulations. Shadow banking has grown significantly since the 2008 crisis, and while it provides a source of financing, it also introduces new risks, particularly because these institutions often engage in high-risk lending and investment practices. As we reflect on the lessons of Lehman Brothers and the 2008 financial crisis, we must acknowledge that while progress has been made, the global financial system remains vulnerable. The story of Lehman Brothers serves as a stark reminder of the dangers of allowing financial institutions to grow too large and too interconnected to fail. It's a cautionary tale about the consequences of prioritizing short-term profits over long-term stability. Lehman Brothers may have vanished, but its legacy lingers in the policies, reforms, and debates that continue to shape the global financial landscape today. The firm's collapse not only reshaped the financial industry, but also had profound implications for how governments and regulators think about risk, regulation, and the responsibility of financial institutions to the broader economy. Ultimately, Lehman's downfall serves as a powerful reminder that financial crises are not just abstract events that affect stock markets and banks. They have real, far-reaching consequences for ordinary people. As we move forward, it is crucial that we remain vigilant, ensuring that the lessons of 2008 are not forgotten, and that we do everything we can to prevent history from repeating itself. So, as we ask ourselves whether we are safer today than we were in 2008, the answer remains unclear. While regulations have improved, new risks have emerged, and the next Lehman Brothers may already be lurking in the shadows, waiting for its moment to trigger another crisis.